Welcome to Keystone Strategy Trading in this presentation for evaluating a strategy. In this presentation today, we're going to talk a little bit about the psychology when evaluating a strategy and how that can creep in to the decision process. We're going to talk specifically about some metrics that you can use to help evaluating your strategy, some black and white numbers that you can use to give a barometer reading of how your strategy is doing. We're going to talk a little bit about curve fitting. We're going to talk about some rules for optimizing to help guard against curve fitting. We're going to look at some drawdowns and kind of go a little deeper into drawdowns and how to use that to evaluate the robustness of your strategy. And then we're going to go spend some time talking about consistency within the strategy and how that can impact the robustness of your strategy. And then we're going to spend some time on high percent profitable strategies. I'll go into details about those and discuss a little bit about how those can be high risk and they can be highly fragile strategies. And then we'll do a quick summary of the presentation. Before we get into the presentation for evaluating a strategy, let me do just a bit of a presentation disclaimer. So the process that we're going to talk about today was really intended to be a measuring stick, if you will, for when you're going through the process of evaluating a strategy. So the intention here was for our customers when they come in, they quickly want to have a sense of, well, what is our strategy looking like? Can you tell me how good do you think it is? So this is really kind of a measuring stick that can be set out there prior to any development of a strategy. So once the process starts, you can quickly look at it, yourself and say, how am I doing? And really not have to have any kind of emotion or discretionary thought process going on as you're evaluating a strategy. It is intended to be a relatively quick and easy process so that you can go through it and establish very quickly, where you're at in the process. And it's designed to be used in its whole and not in pieces. So when you're starting to use this process, take a look at the whole picture and not little pieces of it to get a sense of where you are. And really the intention for this was to help weed out bad strategies quickly. Telling you to go back to the drawing board, don't sit here and fight with the bad strategy. Go ahead and, start over, define new rules, define new logic. It by no means is designed to guarantee you will make money. And so far to date, as we've been using this process, it has been primarily used and tested with single instrument strategies, and predominantly we've been using it on futures and ETFs.
All right, so let's get started first with a little bit of psychology when going through the process of evaluating a strategy. So I find myself and I find my customers getting into a situation where they feel very strongly about a strategy. Maybe they become emotionally invested in the strategy and they start to get some data, and then they start to look at the data and analyze the data, and then they let rationalization start to creep into their decision-making process. So let's just do a quick example of what that might look like. So let's just say you're doing a coin flip. So you know that your odds of winning a coin flip are 50-50. And now let's say that you've done 10 coin flips. Well, on the 11th flip must be a higher odds. You've lost 10 in a row, you know that your odds are 50-50, so the 11th one must be a much higher percent chance of you winning. Well, that's rationalization starting to creep in. So in reality, your next coin flip is really 50-50. It's always going to be 50-50. So this is just a quick example of how rationalization can creep into a thought process when optimizing and designing a strategy. So let's look at another example And this is actually a strategy that was written for a customer, and we'll just call this customer Joe. But Joe had me write the strategy, and we optimized it on 6 months worth of data. Okay, and this is what the performance report looked like, or their equity report looked like for that strategy on 6 months of data, on 1 year of data ending April of 2010. So once we completed the optimization process, we gave the strategy some unseen data. Okay, so the next chart you're going to see is the results of 2 years of data ending on April 2010. And as you can see, the strategy started to struggle as it got unseen data. So right in here is where my customer started to look at this data and analyze that data and try to figure out what happened to the strategy during this time period. Well, as he investigated this, he realized that this was trades that were taken during the 08-09 crash of the market overall. So he started letting rationalization creep into his mind and say, hey, maybe this will never happen again. And look, I've got a whole year's worth of data where the strategy has done very, very well. So I might consider going ahead and trading the strategy, even though I know that unseen data produce some undesirable results. So let's talk about some examples that I hear from my customers and that I myself have even used to try to evaluate a strategy and rationalize whether I should use the strategy or not. So, for example, there was a major crash. That was the example that we saw that Joe took. Maybe there was some significant events that impact the market, and that may never happen again. Maybe there was some major event. Maybe it was the mortgage crisis, or a credit crisis, or bank collapse, or government bailout, or maybe there was an oil crisis, or maybe it was the Japanese tsunami. I hear all kinds of rationalizations for looking at the data and rationalizing away some of the results that we get from going through the optimization process. So now let's go back and take a look at Joe's strategy. So we're going to fast forward a year. So this chart shows the optimization period at the beginning, and then it shows a year's worth of data that happened after the optimization. So you can see right here at the top is the end of that optimized data. And this is where Joe rationalized that he could go ahead and start trading this strategy. And you can see the results were very devastating to Joe's strategy. So I just wanted to spend some time on rationalization and how that can very easily creep into your thought process, and you need to guard against allowing that to enter into your process when you're trading or optimizing a strategy and considering whether you're going to trade this strategy or not. All right, let's get started and look at some specific metrics that you can look at that will help you evaluate how your strategy is doing as you go through the optimization process and backtesting process. So the first thing we're going to look at is called the 1.2 rule, and this is nothing new. This has been tossed around by many people to try to help evaluate a strategy. And again, I would not take this one metric to determine if my strategy is good or not. I would just use this rule as a starting point to determine, can I continue on the optimization process? Can I continue on the evaluation process to determine if this is a strategy worth trading or not? So let's talk about how this 1.2 rule works. So what you do for the 1.2 rule is you multiply the profit factor times the percent profitable, and then you multiply that times the win-loss ratio. And what you're looking for is a result of 1.2 or better. So let's just go through that process. Now this is an example of a TradeStation performance report that shows the numbers that we're looking for and the metrics that we're looking for to calculate the 1.2 rule. And this is available, I'm sure, in most platforms, but even if it's not, you can do these calculations yourself to get the profit factor and the percent profitable and the win-loss ratio. So in this example, what we're seeing is the profit factor is 2.34 and the percent profitable is 62.66 and the win-loss ratio is 1.39. So let's take those numbers and go through the process and see what we get. So with a profit factor of 2.34 and a percent profitable of 62.66, we're actually going to use 0.6266 in our calculation, as this is a percentage, and then we're going to multiply that times 1.39. So here's what the calculation would look like. 2.34 times 0.6266 times 1.39, and the result is 2.04, and that is a rounded number. And so in this example, we were looking for 1.2. So in this example, I would say, you can continue on through the process of evaluating your strategy, continue the optimization process. If it's less than 1.2, I would say you probably need to go back to the drawing board and continue working on your strategy. So the next thing that I would recommend you do as you're going through the optimization process is to look at the RENA index. Now this is available on TradeStation. It's essentially a risk-reward ratio. So if you're using a different platform, I'm sure there's other calculations or metrics that you can look at, but essentially what you want to find is a risk-reward ratio that will help you evaluate as you're going through the process, is your strategy getting better or worse? And it takes into account not only the profit, but time in the market and drawdowns. For example, if you're comparing two different strategies, the one that has a RENA index that's higher is actually a better strategy because it has a better risk-reward ratio. You can also use this to compare your strategy before and after you're doing an optimization, or before and after you're doing any kind of logic changes. You need to keep an eye on this number. You need to know what the number is before you did any kind of thing to your strategy, and then look at it afterwards. And if you're improving the number, then you know that you're improving the strategy. If it's going down, then you know that you have an adverse effect on your strategy. Just go through, as you're going through the process, just keep an eye on this to help you see, give you a temperature reading of how you're doing with the strategy.
So the next thing to look at when you're evaluating a strategy is the drawdown. So what we recommend is taking the back-tested data, determining what the largest drawdown is, and then doubling that. And then base your decisions going forward on whether you want to trade the strategy on twice the back-tested drawdown. So you need to ask yourself the question, can you financially and emotionally trade through this drawdown? Can you emphatically commit to that kind of investment in trading this strategy? So for example, let's just say you determined that the largest drawdown on back-tested data was $1,500. We're going to double that, $3,000. So can you emphatically commit to investing $3,000 or risking $3,000 in order to try and trade this strategy in a live market? And if you cannot make that commitment, then you probably should reconsider whether you should even be trading the strategy or not. Now, the next thing that I like to look at when evaluating the drawdown is what's called the losing series. So TradeStation provides another report called the losing series. What this is telling us is that we had a losing series of 77 times, and the average loss was 203.70 before there was a profit, and the next average profit was 294.51. So as you go through this, you can see that you had a losing series of 33 times, and the average loss was 186.63, and so on and so on. Whereas the last one is 5. You had a losing series of 5, and that happened twice, and the average loss was 162.50 before the next trade was a winner, which was 332.50. So what I like to do is kind of dig a little deeper into that to kind of give myself a sense for the kind of heat that I'm going to take on this strategy. And again, this is no guarantee this is what you'll experience in reality when you're trading on a live market, but it is a good barometer or a temperature reading for the kind of heat that you could likely take going forward. So what I do for this calculation is I take the losing series column and I multiply that times the average loss per series, and the result is the amount of drawdown that I could expect to see for that losing series before the next trade is a winning trade. So in this example, I start kind of at the bottom, and I see that twice I had a losing series of at least 5 trades in a row that resulted in an average drawdown of $812.50. Then I start working myself up from there to see, how much heat am I taking those? How many times am I getting these drawdowns and how significant they are? So in the next example, I had 4 times in the back-tested data, I had losses 4 in a row of an average of 215.94. And then when I multiply that out, I see that the drawdown was $863.76. So 6 times I had drawdowns ranging from $800 to $863. Well, if I go up one more, I had 3 losses in a row 13 times. So if I add those together, I got 19 times I had drawdowns anywhere from $500 to $863 during the back-tested period. So this really gives you kind of a better sense for how much heat and how many times you're going to be taking this heat during the back-tested results. So going forward, there's no guarantee this is what you're going to get, but it will give you a sense of what you can likely see going forward if you're going to consider trading this on a simulator or in live market. So I get this question all the time: when and how big was your largest drawdown? And again, I'm trying to change the mindset when you're looking at strategies. So my answer to this question is always, I don't know, I haven't seen it yet. I always know that when I start to trade a strategy live that I likely have not seen the largest drawdown. I know historically in backtesting what the largest drawdown was, but I know that that's not likely going to be the largest drawdown going forward. And my mindset should be more of, my largest drawdown's likely going to be twice that, and I don't know when it's going to be. So the next thing we want to talk about is consistency. So you've gone through the process of optimizing your strategy and everything's looking pretty good. So now let's take a look at consistency in your strategy. So we're going to look at consistency on all parts of the strategy. And this is just some examples of the kind of things that you need to be looking at to see if you have consistency in your strategy. And the more consistency, the better, the more robust your strategy likely is, or likely will be. Okay? So for example, the first thing we want to look at maybe is the long versus short entries. So how is our metrics doing long versus short? What are the number of trades long versus short? What is the profit factor long versus short? What is the percent profitable long versus short? What is the win-loss ratio long versus short? And what is our drawdown long versus short? So for example, let's just say that our percent profitable for longs was 70%, but on our short entries it was only 30 or 40%. Well, when I see something like that where there's that much difference, it starts to raise a red flag, and I want to spend some time looking at that and determining, is that's really a strategy I want to trade, and why did that happen? Was I not evaluating across all kinds of markets, bull markets and bear markets, that sort of thing? Does my strategy only work really well in a bear market, or does it really work only well in a bull market? So the next thing you want to look at is time periods. Look for consistency across your time periods. So for example, if you're trading a strategy across multiple years, look at the trades per year. Look at the profit per year. Look at the drawdown per year. Let's just say, for example, that you had a strategy that made $100,000 over a 5-year period. Okay, but then one of those years, it made $60,000. Well, that should also raise a red flag for you. Would you really consider trading this strategy if we took that year out and said, you know what, you may never see that great of a year again? All you're going to see is the years that were not that great. Maybe it was one of the lowest years. Would you still consider trading this strategy? Is it the average of all the years except for the best year? Would you really want to consider trading that strategy? So take a look at the consistency across your strategies. And again, the more consistency, the more robust your strategy likely is. So the next thing we want to look at is high win percentage strategies. So what does that really mean? Well, typically high win percentage strategies equal high fragile strategies, or high winning strategies, percent winning strategies typically equal highly risky strategies. So let's take a look at an example. So I created this strategy specifically to prove a point. So this is not a strategy you want to trade, but it demonstrates a point. This strategy produces 98% win. So 98% plus times out of the back-tested data, it would win. Okay. Well, let's go look at the equity curve for 6 months ending June 2014. So this is that strategy, and here's what the equity curve looks like. So now let's give this strategy some unseen data. So we're going to fast forward this strategy for 2 months. So now we're going to show 6 months ending August 2014. And here's what the results were. So again, this strategy was designed specifically to prove a point. But as you can see, by giving this strategy some unseen data, we've revealed how fragile and how risky this strategy actually is. So be very, very careful when you're evaluating a strategy, whether it's your strategy or somebody else's strategy, and they produce results that say that it's a high winning percentage strategy. So let's take a look at some examples of some strategies that I actually evaluated. These are commercially available strategies, so you can go out and you can pay a fee to trade these strategies. Okay, and what I find interesting is, as I've gone through the process of evaluating different trading rooms and their strategies, they invariably want you to log all of your trades. So they're going to coach you and teach you how to be a good trader. And they say, well, the first thing you need to know is you need to be able to, log all your trades, evaluate those trades, and determine, how you're doing as a trader. Well, I started evaluating these strategies, and these are 2 that I specifically went to go evaluate, and they were high winning percentage strategies. So in this first example, it was advertised to be a 80 to 90% winning strategy. So you would win 80 to 90% of the time. Well, knowing that this same firm said that I needed to be logging my strategies or logging my trades, and by the way, we log our trades as well, my first question was, well, okay, great. So what's your profit factor and what's the win-loss ratio? That will really help me do an evaluation of whether I want to trade your strategy or not. And invariably, I get the answer is, well, we don't have that information, which I kind of find interesting because you just told me that you log all your trades and that I should be logging my trades as well. But okay, so we don't have that information. So what information do we have? And can we still do some sort of an evaluation of this strategy without all that information? Well, for this first example, I was told that the profit target is $200. Okay, great, that helps. Well, I was also told that the stop loss is $1,200. Well, that actually should raise a red flag in itself. But let's go ahead and let's just go through the process and see if we can do any kind of evaluation with the information that we have. So we're going to go through this calculation. We know that we have a profit target of $200. We know that the stop loss is $1,200, and we know that our commissions are $5. And let's just say that we trade your strategy, or we traded this strategy 100 times. And let's go through a simple calculation and see what we get. Well, so let's just say we win 90% of the time. So let's take 90% times 100, and we know that 90 times, or 90 trades, we would win $200, and we multiply 90 times 200, and we get 18,000. We also know that we would likely have lost 10 times. So if we multiply 10 times 1,200, we get a negative $12,000. Well, the net of that is $6,000. So we do indeed make money on this strategy if we win 90% of the time. Well, if we also take out commissions, we only made $5,500, but we're still winning. Well, now let's say that that percentage actually dropped down to 85%. Well, if we do the same calculation, we do 85 times 200, we get 17,000. And if we do 15 times 1,200, we get a negative 18,000 for a net of minus 1,000. And then we factor in our trading commission, and we get a negative $1,500. Wow, so we quickly went from a profitable strategy to a losing strategy just by evaluating the percent profitable and dropping it down just a bit. Well, we can do the same calculation at 80%. And by doing that calculation, we actually dropped down to $8,500. So we lost $8,500 on this strategy if our experience is only 80%. So let's just do a second example. This is another strategy, again, a commercially available strategy that I evaluated. And once again, I was told that this is a high percentage win strategy, wins 95% of the time. And of course, my first question was, what is the profit factor and what is the win-loss ratio? And once again, I was told that data is not available. And by the way, this same firm coaches and teaches to log all your trades, and by the way, they log all their trades as well. So it was kind of interesting to find out that they don't have that information. I was told they don't have the win-loss ratio. They don't have the profit factor. But okay, let's just continue forward. And what information do we have? Well, we know that the profit target is $25. Well, that doesn't seem very large. Okay. Well, what's the stop loss? Well, it's $250. Again, red flag should be going up. But let's continue on. This is a commercially available strategy, so let's continue on and see what we find. Well, let's do the same calculation. We're going to assume that we traded their strategy 100 times. We're going to assume the profit target was 25, the stop loss was $250, and that our commissions were $5. Well, at 95%, we get the result of $625 after commission. If that were to drop to 90%, we start to lose money. We've lost $750. And if that were to drop to 85%, we'd actually be losing $2,125. So for me, when I look at that, I'm thinking, wow, I'm at risk for 100 trades, and even if I get the percent profitable that they advertise, I'm only making $625. So I'm going to risk being in the market for 100 trades to make $625. So as you can see, if the percent wins drop just slightly, they can quickly move to be very unprofitable. So again, be very careful when you're evaluating either your strategy or somebody else's strategy, and it is a high winning percentage strategy, because they can become very fragile and they are typically the result of a lot of risk. All right, so next let's talk about curve fitting. Okay, so what is curve fitting? Well, simply defined as applied to strategy design, curve fitting is developing logic or programming instructions that will align with historical data to provide the most desirable results. So when you do your optimization or when you put your filters on the strategy, you're putting the ones that will give you the best results over the back-tested data. So by definition, backtesting and optimizing a strategy is essentially curve fitting. So really our goal cannot be to eliminate curve fitting. Our goal is going to be to try and ensure that we are not overly curve fitting our strategy. Well, the question then becomes, how do we go about doing that? So here is some backtesting rules that you should consider when you're going through the optimization process. 1, backtest on a large sampling of data. 2, feed your optimized strategy. So once you've completed your optimized strategy, then give it some unseen data or out of sample data. Ensure you've tested your strategy on varied markets, bull markets, bear markets, all kinds of conditions that you can find to test your strategy on. Then run your strategy on a simulator in a live market. See how your strategy behaves in a live market. And then, of course, ensure that you factor in all of your trading costs. Your bid-ask ratio spread, or your bid-ask spreads, your slippage, your commissions, all of the costs to take that trade. Make sure you factor those in prior to doing any of your optimizations. So I get asked this question all the time, and this seems to come up a lot. How much data is required for backtesting? And I constantly hear, oh, well, if you have at least 30 trades, that's good enough. Well, I really think the mindset should be not how little can I get by with, but how much data can I get? The more data, the better. The goal should be get as much data as possible. Get as many trades as possible. The more trades, the more data, the more statistically correct your results will be. So let's talk about some specific TradeStation parameters. Now I'm focused on TradeStation, but these parameters are likely available in any platform that you may be using. But you need to be looking for these parameters and ensure these parameters are set prior to doing any kind of optimization. Now this won't guarantee that you're going to get results, the same results that you would in a live market, but it's going to help ensure that you're getting as close to live results as possible. So the first parameter that we want to look at is the fitness function. Okay, now the fitness function is essentially what is TradeStation going to use to sort its results. So as you go through an optimization, let's just say you're optimizing on a moving average or a stochastic or an RSI or something, and you're using different links and you're doing different results for oversold and overbought. When you get those results back, it's not going to look at specifically the parameters that you use for the moving average. It's going to be looking at, okay, when you used all these different parameters and I give you the results back, which one produced the best based on my fitness function? So for example, if you use the net profit, it's going to sort by the net profit. So whichever results gives the best net profit is what it's going to tell you is the best results. Now TradeStation offers a fitness function called the perfect profit correlation. And essentially the perfect profit correlation is trying to optimize your equity curve. So it's taking in consideration not only the net profit, but it's also taking in consideration your drawdowns. So it's trying to straighten out your equity curve as best it can. So this is the parameter that I personally prefer to use when I'm getting ready to optimize a strategy. And then of course we've talked about the commission and slippage. So you want to make sure that you enter in your commission and slippage. And on TradeStation, you enter that in and it's per trade. So if you're doing a round trip, so let's just say your commissions is $5, then you would want to enter in for your commissions $2.50 because it's taking each side of the trade at $2.50 for a round trip of $5. And the same holds true for slippage. So if your experience, let's just say, has been 2 ticks of slippage for every trade, so you would enter in 1 tick for each trade to give yourself 2 ticks for round trip. So for example, on crude, the crude futures, let's just say you wanted 2 ticks of slippage on crude for every trade, every round trip trade. That would equate to $20. So you would be entering in $10 for each trade. And then the last parameter that you want to look at and make sure you set is one called the fill entire order. Now what you want to set this to is to fill the entire order when the trade price exceeds the limit price. So if you've done any kind of trading at all and you've had a limit price sitting out there, invariably what will happen is the market will trade up to your price. It'll trade your price for a while and then it'll retreat back from your price and you didn't get filled. Well, when you're doing back testing, what you want to happen is you want the market to have traded through your price to guarantee that you would have gotten a fill. So this will help ensure that you're getting closer to actual real-time results. So historically, if the price traded through your price, then if you were actually trading that strategy, you would more likely have gotten filled, or you would have gotten filled than if you had set this just to go ahead and trade or count the trade as a fill if it trades to your price. So be sure and set this parameter to fill entire order when trade price exceeds the limit price. So let's just take a quick look at commission and slippage and why that is so important. Okay, I wrote this strategy to quickly demonstrate and show how important commission and slippage can be for a strategy. So this is a simple strategy that says buy when the close is higher than the open and sell when the close is lower than the open. And there is no commissions or slippage factored into the strategy. So on the second chart, I added the commissions and slippage. And here you can see that that strategy quickly turned around from being a really looking like a great strategy to one that is very poor strategy. So be very careful to make sure that you put in your commissions and slippage prior to doing any kind of optimizations. All right, so let's just do a summary of what we talked about. First of all, there is all kind of data available today. The technology that's available makes it very easy and inexpensive to get, and you should obtain as much as data as possible, as many data points as you can get. And if you do that, the data can and will reveal the robustness of your strategy, or for that matter, the strategy from a vendor. So get all the data you can and let the data tell you whether your strategy is good or not. And then follow these simple rules that we've discussed today. 1, feed as much data as you can to your strategy. 2, feed your data or your strategy unseen data. So once you've gone through the optimization process, feed it unseen data. And TradeStation has a tool called Walk Forward Optimizer, and we highly recommend using that as well to help you see how your strategy performs with unseen data. Third, run your strategy on a simulator. See how it performs. Watch it perform and see how it does in a live market. See if you're getting similar results to your back-tested results. And then on the simulator, you will get some slippage. It's not going to be the same slippage you get in a live market, but it will simulate some slippage. Listen to the data. When you get the data, pay attention to what it's telling you. Don't discount the data. Don't rationalize it away. Remember, Your biggest drawdown has not yet occurred. Then ask yourself these questions. Does my strategy pass the 1.2 rule? Can I trade through twice the back-tested drawdown? Ask yourself if you're rationalizing. Be very careful with rationalization. I'm not saying that you can't use rationalization to evaluate your strategy, but be very careful with that. Get a second opinion. See if somebody else agrees with your rationalization. But be very cautious when you're starting to rationalize the data. Typically, it's better not to rationalize. Well, thank you for joining us for this presentation of evaluating a strategy.